What's up, mortgage pros? Austin Nemec here, and welcome to Pro Talks. We're coming to you from Detroit, Michigan, the mortgage city, in our rock studios. And the market, it's wild. We're seeing shifting, changing. You got all sorts of buzzwords and headlines. And as a mortgage pro, it's important you know what's going on, so you can not only prepare, but do an incredible job communicating to your borrowers, your real estate agents. And as your partner, we're here to help. So today, we got two powerful guests here on Pro Talks. First, Mr. Bob Walters. He is our Chief Executive Officer here at Rocket Mortgage, leading all of Rocket Mortgage. He's been with the organization over 25 seasons, Bob. I think you started at 10 years old, broke some labor laws. But he'll be joining us along with the powerful Mr. Bill Banfield, who is our Chief Risk Officer, working with Wall Street, ensuring we're rolling out the great products for you guys to go out there and win business. So, Bob, Bill, how are we doing today?
Doing great.
Good. We brought in a fancy set. We got some plants. They're real. We watered them prior to. So we're excited. So before we get into it, I got a lot of questions. But why don't you take, Bob, 60 seconds, under 60 seconds, walk the powerful group through, how you got to where you're at today within the organization.
Wow. So like you said, I started in 1997, Rock Financial at the time. Rock Financial was about 350 people at that time. They brought me in to run capital markets. I like to say that sounds awesome until you realize that was 3 people. But it's been an interesting journey. Now the mortgage company is more than 15,000 team members, and the family of companies is more than 25,000 team members. So it's been a terrific ride along the way to go from, I came in here as a bond trader, trading mortgage-backed securities, to running capital markets and then servicing and operations and now technology and all those other things. So it's been interesting. And I know we'll talk about this today. One of the things that I was responsible, and Bill's been responsible, Bill and I have shared an office wall for 22 years. That's a true story. But one of the things that was always important to me, and one of my most important roles, and certainly Bill's, was figuring out and ensuring the liquidity of our company. Liquidity meaning, who do we sell the loans that we're making to? Because, and whether it be the financial crash, whether it be what happened in early days of the pandemic, what can happen if you lose liquidity, if you don't have the right investors or enough investors, you can find yourself, and we saw it happen in the financial crash, hundreds and hundreds of very strong, viable mortgage companies collapsed overnight because they didn't have that liquidity. And so, that was one of the things that I was involved in and Bill's been involved in, so I'm looking forward to talking about that.
That's great. Thanks for joining. Bill, 23 seasons here at Rocket.
That's right.
Let's walk us through how you got here today.
Well, it's funny. I started with Bob. As he said, the company was a lot smaller. It was 1999.
Yeah.
And was right smack dab into pricing, products, post-closing, and all that. And as the company grew, so did the responsibilities of the group. And when Bob became president, I took over the part of capital markets I didn't already have. That's now expanded, to include our legal risk and compliance groups. We have our revenue operations groups that ensure that leads get to where they need to be. A lot of analytics, a lot of risk management, but it's great. And as Bob said, making sure that you can deliver on your promise to your clients, your partners, is a core part of what we focus on.
Yeah, it's great. So we're going to talk about the state of the market today. Then we're going to get into maybe the future of the market, look into the crystal ball, and then talk of some philosophy and leadership. It's important that the mind is right to be successful in a market like this. So first, I think if there's going to be the buzzword of 2022, like word of the year, it's going to be inflation. You hear it all the time. And it's all over the place. We had some news come out yesterday. But before we get into what we think is going to happen with inflation, obviously inflation impacts everything we do, from rates to home values. As a mortgage pro, it impacts our daily, weekly, monthly business. So how did we get to record inflation? How do we get to where we're at today?
You want me to take that?
Yeah.
I mean, I give you the 7-hour answer, or you could. Bottom line is that the pandemic was such an unusual event. It is a once in 100-year event. Overnight, unemployment went from, call it 4% to 30%. Literally, and you can look at the chart, it's the most remarkable thing you've ever seen. And so the government responded very, very quickly, and they needed to. We can debate whether they made all the right moves or not, but they did so they infused about $7 trillion of liquidity into the market in various different ways, whether unemployment checks, whether it be some of the things they did under the CARES Act, whether it be forbearance, whether it be things they were doing for businesses, whatever. Just a gigantic amount of money came into the economy to really stop what could have been ugly with so many job losses and those kinds of things. That, coupled with huge supply chain problems, meaning if you can't easily go to work in factories, or if you can't do things, then you start to see problems. I remember they had problems because they couldn't go into, for example, the places where they process meat, for example, and that got backed up. Or certainly the shipping, and you see things like that. The problem is, it doesn't take that much of that before all of a sudden there's too much money chasing too few goods. That was the old definition in Econ 101. And you get too much money chasing too few goods. That money's got to go somewhere, and it goes into price. We saw it happen with home prices. We saw it happen with all kinds of things. So that's my version of how we got here. There's a lot more things you could talk about, but that's kind of the big picture.
Yeah, and I would just add, that got expanded as the Ukraine situation took off, affecting commodities and food prices, and gas prices continued to go up until just recently. So it's just been a snowball effect, and obviously everybody's heard it. It's in the media all over the place, but prices are going up everywhere.
Yeah. So yesterday was a big day. A lot of people were waiting on the CPI numbers. And for the first time in a long time, I don't want to use the term inflation cooled down. I think it got less hot. And so we were in the lower 8s versus we've been running at 9% month over month. How has that impacted the current market today? And how do we think that's going to impact the decision Fed will make in September when it comes to rate hikes?
Well, so yesterday was good news, but you also got to look deeply. A lot of that was because energy prices have fallen.
Yeah.
A huge part of that. So if you look at wages and you look at food and some other things, those prices are still rising. So we're not out of the woods yet. And the Fed knows that, and so that's what the Fed is trying to do. Essentially, I think of the Federal Reserve as like driving a car. When they want to speed things up, they pump money in the economy, they're hitting the accelerator. When they want to slow things down, they pull money out of the economy by raising rates, and that's like hitting the brakes. Right now, they're hitting the brakes. And, I tend to think that the markets are anticipating between 1/2 and 3/4 next time. The next time they meet, I think they'll go 3/4, but we'll see.
3/4?
Yeah, I was telling Bob, the market's got 60 basis points priced in right now, which means they're hedging right between there. We're not sure if it's going to be 50 or 75, but it sure does seem like the Fed has alluded to they're going to keep their foot tapping the brake here until they get inflation more under control. And yesterday, the CPI data was, it's the beginning, but it's just one data point.
Yeah.
I would say this, though. What we care about as mortgage bankers, the Fed funds rate is the overnight rate at which banks borrow and lend from each other, literally overnight. So it's not something you and I engage in, although it is that foundational rate for the economy. But the rate that we transact in, for the most part, are longer term rates. And those rates are determined every day by the markets. There's no group of 9 people deciding what mortgage rates. It is literally tens of thousands of mortgage traders every day buying and selling mortgage-backed securities that moves those rates up and down. And we've seen them rally nicely, and it's because they're thinking 10 years ahead. What a person who owns a 10-year bond or a mortgage bond, they're like, what will my return be over a long period of time? They're like, yeah, I know what rates are today, but what are they going to be next year and the year after that and the year after that and the year after that? So that's why they're saying, oh, the Fed is hitting the brakes. We think what they're doing is going to work, which is why you've seen interest rates come down some. That said, there's very little likelihood we're going back to the 3% long-term rates that we were enjoying last year. We'll probably trade in some range between 5.5 and 6.5 on a 30-year fix, maybe give or take for a while.
That's good. For those of you at home, if you want to ask some questions, you can go to pollev.com/ProTalks. It's the old school way to do it. Or there's a QR code, which the kids are doing these days. Take a picture of it, ask questions. But we talked about inflation. It's a buzzword. Another buzzword is the R word, the recession. And you turn on the news, and people are very passionate about this. Some say, we're in a recession right now, or we're about to be in a recession. And then you hear other folks say, you're crazy, no way, unemployment, it's low, inflation's coming down. So gentlemen, are we in a recession?
Well, yeah, so, the big debate is you've had 2 quarters of decline, which meets the textbook phrase. Even that's been in the headlines everywhere. Interestingly, last Friday, jobs report comes out much stronger than expected. Unemployment rate's at 3.5%. It's a 50-year low. The market's telling you 2 different things right now. And I think that is what is creating a fair amount of uncertainty, which is why rates are going up and down. You're seeing more volatility. All of us, right, on the rate sheets, day by day, rates are going up and down as the market's trying to figure out where are we going to go. Little by little, I think, as the Fed makes rate adjustments and creates some certainty in where we're headed, maybe gets inflation under control, you'll see some of that volatility back down. But it really is a mixed message right now.
Bob?
Yeah.
Are we in a recession?
I mean, if you look at the standard definition, I guess we would be. I'm not overly pessimistic, though, because, when you look at where unemployment is, I mean, it's unbelievably low. And if anything, employers are having a hard time finding people to work. Just talking, a big money center bank was in our offices today, and one of their senior people said that the bank is that consumers have $2 trillion more of deposits than they had pre-pandemic. $2 trillion more. So they, again, why? Because they got a lot of stimulus and because they were spending a significantly amount less money. So you have some pent up demand. So you have pent up demand, you have unemployment as low as it is. It's not really, the environment is not really one where you're like, we're going to see a nasty, nasty recession. So could the Fed overdo it? Sure, but I don't think that's going to be the case.
Got it. So when you see a market shift the way it's shifted, you see some shakeups. We saw a shakeup in the broker space. A top 5 wholesale lender shut down. And you may see more of that. How do you think, Bob, a broker should be feeling about that, and how does it impact their business, and how do you see this playing out maybe over the next 6, 12 months?
I think this is the single most important question facing brokers today. I really do. This is the single most important question facing brokers today. Inflation, interest rates rise, interest rates fall, products come, products go, housing markets cool, housing markets get warm. But mortgage bankers are resilient and they have relationships in their community. They're good salespeople. They build organizations. The good ones always can do well. That said, and I said earlier, one of the most important things any company has. If you're a correspondent, you have companies that are buying your loans. If you're us, you have Fannie Mae and Freddie Mac and Ginnie Mae. We're selling those mortgage-backed securities. But if you're a broker, you have your lender who is the one who is providing those funds. That is, without that, you're out of business, and you're out of business overnight. Yeah. And so we've seen that. And I was telling you earlier, we have warehouse lines. That's how we finance, just like any mortgage company. And we have 14 of them, and 14 that represents about $18 to $20 billion of warehouse capacity. And those 14, we've been very intentional. We have U.S. money center banks. We have some regional banks. We have Canadian banks. We have Swiss banks. So we have 1-year tenor, meaning it's a 364-day facility. We have 2-year tenor. We have 3-year tenor. We stagger them. So why are we so intentional? Because we understand if we put all of our eggs in one basket, we could be in deep trouble. And when you don't have, the other thing is when you don't have liquidity, when you don't have optionality, the other thing on top of you being completely dependent on that one firm is now that one firm exhibits an extraordinary price pressure on you. And so one of the things I worry about, because we saw Loan Depot get out of it, they won't be the last. There are many more coming of people that will exit because right now the wholesale space is just flat out not profitable. It's not profitable. And so firms like us, and we can talk about this, we're public, we have billions of dollars of cash. I think we said we had $9 billion of liquidity. So we're in a great spot. But a lot of these folks are not. And so I say that because if you're a broker, what will your optionality as far as who you're working with look like? And if it's like, I'm going to end up with one, you've just become the net branch of that company. You're not a broker anymore. You're not in control of your destiny. You can't hold that entity accountable to say your price is too high, your service is no good, I don't like your technology, I don't like this, because you're completely beholden to them. And so, look, we know there is a competitor out there who said, I'm very intentional about limiting your choice. I'm this owner of this company. I'm going to decide for you for you who you can do business with. My decision, more important than your decision. And people are like, and during the boom times, people are like, okay, no big deal. Now people are like, uh-oh, Loan Depot just went away. I sent some loans to Loan Depot. Uh-oh, XYZ is about to go away. I sent some loans to XYZ. Where do you end up? And it's like, go back and look at the top lenders in America, the top retail lenders and the top wholesale lenders for the last 20 years. Look at who they were. And what you'll see is they constantly change. There used to be Sears Mortgage Company was one of the biggest. You had Stearns was one of the biggest. There have been all these different names over the time, and they come and they go. And so any lender, any responsible lender who cares about the long-term viability and control of their business needs optionality and liquidity. And if they end up with one, whether it's us or somebody else, that's bad. And where I see things going, I see the universe of lenders narrowing rapidly. And so, you know, if I'm a broker, I want the biggest lenders competing against each other. I don't want them not competing against, because that's bad for me.
Yeah. I think what was very interesting about when the pandemic hit, now that we have time to look back and analyze it, is it was like a really condensed version of maybe what's happening now. Things got very tough, liquidity. And you saw how lenders performed. You saw the biggest lender go into a corner and hide and kind of abandon their partners, where we stood strong and we put the broker community on our backs. But that's an example of the power of optionality and competition. If one hides and goes away, you have the ability to choose others. And what I love about what I do every day is the competition.
Well, I'll tell you, Austin, real life. So again, been doing this forever. Back in 2007, 2008, when Bill and I were running capital markets, we hadn't yet begun selling to Fannie and Freddie directly. So our biggest lender, our biggest investor was Countrywide. But we also, you know, we worked with a bunch of names. Again, Washington Mutual, a bunch of these folks who don't, but those were the big names at the time. Yeah. And Countrywide was very important to us, and they were very big. And we looked at Countrywide and said, there's no chance anything could ever happen to them. They're huge. They were gigantic. And they had all these things. And you know what? They collapsed. Overnight, they collapsed. And so did Washington Mutual, and so did Wachovia, and so did Lehman, and so did Bear, and so did all these other companies. And so none of us saw that coming. And thankfully for us, we had other relationships with other lenders that were, you know, some were banks, some were not banks, and we were able to work our way through that time. But I sometimes think about, had we put all our eggs in that basket, or had we been completely beholden to them, things would have probably turned out differently for us.
Yeah. I know we've had a few brokers reach out and said, hey, we saw Loan Depot got out of the business. What is your stance? Or you get, and it couldn't be further from the opposite.
That's bad. It's bad for the broker.
Yeah. That was our position. We couldn't be more committed, and we're only getting started. We're just warming up. So we're here, and we're here to stay long term. All right, let's switch gears to inventory. The market, obviously, the refi market shrunk a little bit, a bit, and purchase becomes very important. And but we've seen purchase across the industry go down month over month, and we're seeing less new listings, although more inventory. How do you see the purchase market, especially when it comes to inventory shift and change over the next 12 months?
Well, look, I'll take this one. We don't exactly forecast it. Just like Bob said earlier, we don't even get into worrying about the rates. But when you take a look at what's happening right now, we are seeing an increase in listings. The Real Estate Association put out a 31% increase in active listings last month. We're all seeing drops in prices happen, where there's a bigger increase in the number of people repricing their home, reducing it a little bit. That doesn't mean prices are falling. I think what it does suggest, though, is you're going to see more people buyers, be able to negotiate a little bit more, maybe have a little more inventory to choose from. It actually makes the market healthier. Yeah. I think for all of us, it doesn't matter where you sit, it begs the question of appraised values. Yeah. So sometimes the appraisers will pick up on changes, relative changes up or down, faster than the homeowners will. And so that's going to be an interesting thing for all of us. And how does that play into, well, for example, on cash out refinancing even? Are we overestimating values of homes? Or does the appraisal come in lower? And I'm not suggesting we or anyone else has a problem, but through the trends, that's usually what happens, is the appraisers will pick up on some of these changes faster than some of the sellers.
That's great. So I was a loan officer for many years, and then I ran a team of loan officers. And one of the things I appreciated about both of you is as you're in the trenches leading our capital markets team, you'd always surface with an awesome niche product. Like, hey, don't forget about this. You might be overlooking it. Here's how you should package it. Here's how you should sell, and here's how you can help grow your business. Are you seeing any niches right now that mortgage pros should be aware of and using to win business?
Because look, he's the guy who really knows. He runs our capital markets, he runs our product team. So, but one of the things I've learned from Bill, I've learned a lot of things from Bill, but he often coined this term called brand the bland.
Yeah.
So brand the bland meant even if you're doing something that everyone else has, how you position it is really important. Do you name it? Do you name that thing? The other thing is, on a rate sheet, and nobody in the world is better at this than Bill, you can look at a rate sheet and you can go, oh, that looks like a rate sheet. There looks like, oh, there's a 0-point rate, and okay. Or you can say, inside that rate sheet is gold, is opportunities. Like, look at that buy down between those two rates. That is unusually wide. What a great opportunity. Or wait, did you see what happens if you could go from 85.1% to 84.9%? I mean, this is an obvious one, but the PMI factor drops. Or, hey, look at this. When this LTV changes, this happens. But over in here, the point is that when you have multiple investors and you have multiple products and you have many different rate and point combinations, you have all these different permutations, and I promise you're going to find areas of opportunity where things are priced in a way that there's gigantic advantage if you understand it and read it. But you have to be looking at it and being thoughtful about it. So sometimes we'll talk about jumbo and seconds, and I want you to talk about that. But just realize that on a plain old, good old-fashioned 30-year fixed rate sheet is gold for those who understand it and want to go in there and look at it. And you can differentiate yourself from other lenders who aren't willing to do that work or don't have that level of savvy by really putting your clients into a position that helps them take huge advantage. Some people think, well, we're all looking at the same rate sheet. In a way, yes, and in a way, no. Because, just because there's a difference between what's there and what you see. And some people see things that are far more advantageous than others.
Yeah, I remember when I started as a loan officer, there was a gentleman that sat next to me, his name was Evan, and he'd print out a rate sheet every morning and it would come out. And then at lunch, we'd eat lunch together, and we would just study that thing and dissect it. Hey, what are you seeing? Look at this. Look at the spread. Look at the diff. If I go from a 4.99 to a 4.875, that's the sweet spot. That's what we're going to sell today. Or what if I just went to 80.1 LTV and then bought out the MI? It's actually better priced out. And just becoming a scientist and just loving the game, you're right. It's fun.
Yeah.
Fun, right?
Yeah, I was thinking back to, we started our wholesale channel in 2010.
Yeah.
And I remember talking to Bob, and I said, this channel is going to make us better. And I knew it would make us better because brokers, they just know the business so well, and they're making their living through this, and it's like the nuances even at a local level. The feedback helps us, learn, open up opportunities for you guys, and then provide liquidity and tools to help you run your business. But within that, I've always been a fan of printing the rate sheet and looking at it. But there's other nuances like MI. We have the lowest MI in the country. Others chase us and claim they have low MI. We have the best. But even within that, there's a nuance. So you can get the best, but if you add a co-borrower, it gets cheaper. Having a second borrower has been proven to have lower delinquencies, and so the MI companies give us a benefit. Believe it or not, most of the industry, everywhere you go, 45 to 50% of loans have a single borrower on it. So if you have the opportunity for a co-borrower, and you're willing to add the income and documentation, it's a way to knock it down a little bit and make it more affordable. But the other thing, like right now that I think about, there's two categories. It's a purchase and a cash out market for sure. We offer Borrow Smart. It's a Freddie Mac product right now. It's for low to moderate income borrowers, and depending on the situation, you can get $1,250 or $2,500 in free money. And we're seeing different firms pick it up, different brokers pick it up faster than others. Yeah. Because it overlaps with some other products. So it's a nuance. Here's another example. Fannie and Freddie are making some changes to the underwriting guidelines in the black box, right? So you've got a little bit tighter guidelines on cash out. FHA cash out below 680 is a great option, and I think a lot of people are missing the opportunity there. So the beauty is, well, the last couple of years have been phenomenal from a volume perspective. This is a product market. And if you love the business and you want to learn like where there's some opportunities, you just got to comb through the stuff. And for us, I would argue, take a look at Pathfinder. We try to promote everything we can in there so you guys can see what opportunities there are and give us feedback. We're always open to ideas or nuances that you guys think are great.
You know, you mentioned Pathfinder. Pathfinder is probably 5 years old now, and we spend about $4 million a year on Pathfinder. It's people, really. That's what we have, a team of 16, 18 people working on that, and then there's we're patched in with Google, the Google appliance, search appliance, and now, because if you think about the guidelines. You got Fannie's guidelines, you got Freddie's guidelines, you got FHA's guidelines, VA guidelines, jumbo guidelines, it goes on and on and on. And so whether you have your all regs or whatever the case may be, the point is the number of rules in there goes into the hundreds of thousands. And the permutations of possibilities goes off the charts. There's no way any individual can possibly understand all that. So, but computers, I have this little saying I always say, let computers do what computers do well so humans can do what humans do well. Computers aren't good at being empathetic or influencing and persuading other humans. They're not good at that. But what computers are good at is sifting through millions and millions of records and finding relationships that the human could never find. Are you going to sift through 100,000 pages and try to figure it out? That's just not something that we're able to do effectively. And so when you use something like Pathfinder and you've got the wisdom of the people that we have some of our best underwriters, some of our best mortgage bankers we pulled off the floor that build and curate Pathfinder every day and put it together. It's not just a guideline engine. It's much more than that. It is a path to yes. So it's like, well, you can't do this, but Pathfinder will say, but if you switch it to Freddie, you can. It's a path to yes. And I often say to folks, especially when I'm talking to our partners, what is your number one expense? Your number one expense. And it's a trick question because it's not leads, it's not people, it's not real estate, it is fallout. It is the loan you didn't write. Because, if you're earning 2 points on a $400,000 loan, that's $8,000. And if you can't write that loan because you can't find a path to yes, that $8,000 is gone. 10 of those a year is $80,000. So if you have something like Pathfinder that helps you find a path to yes, that thing can be worth its weight in gold. And so we really think that's a huge differentiator for us in the time. And so it's exclusive to our partners. Yep. And in fact, sometimes when we do have partners who leave us, it's rare, but it happens. The one thing they say is, how do I get Pathfinder though? Can I pay for Pathfinder? How much is Pathfinder? And the answer is that, quite frankly, that's just something that if you're a partner, you get access to for free. And if not, then comb through all regs.
Yeah. It's a stress reliever. If you're a broker owner building a company and hiring, my goodness, does it help train and help you become more efficient? So you're not answering phone calls 24/7. But yeah, it's just a powerful tool. If you're not using it, get in there, call your account executive, use it. There's about 15 questions from our partners on the screen. Almost all of them relate to this. So we're going to consolidate it all into one. Product expansion. As the market shifts, folks start asking a lot of questions about product diversity. How are we approaching product diversity as a company?
I mentioned a moment ago, it's a product market. And so I'll share a little behind the scenes. One of the ways we look at this, as much as we, and Bob talked about, we want to provide you guys with liquidity. We also want to make sure that we have liquidity on the backside. And the reason why we think about that is we want stability. We want to make sure we can deliver the product, the pricing remains good, and that we have more than one takeout. It's sort of a way that we think about it. And it's ironic the way Bob talked about it for you guys having liquidity as well. That said, if I go right to the product level, we are working on rolling out a closed-end second for you guys. We are looking at some non-QM products, including the usuals that you guys have seen, interest only, which by the way is completely different than the way it was 10 years ago. There's options out there now where it's IO for 10 years and then it amortizes over 30 years once the IO period's up, which is nice because you avoid the payment shock. We're looking at the DSCR loans. And all of these have some amount of value to provide. They're not going to take up FHA, VA, or conventional lending, but it supplements it and it helps, I think, as you guys get leads to make sure that you're converting those. And that's a priority for us, that that we're there and we have your back.
Yeah. Yeah, we got a lot coming. To Bill's point, closed-end seconds. We're working on some great interest-only products and all this stuff we're building behind the scenes. So we're getting a lot of applause from the audience here.
That's great. And, it's one of the things we've noticed is that everywhere you go, people are talking about a HELOC.
Yeah.
And when you roll out a home equity loan, people get confused by the name. But I'll give everybody a little flavor. We chose that product for a couple of specific reasons. The Fed's raised rates 4 times. They're going to raise rates more throughout the rest of this year. The prime rate on a HELOC is more often than not tied to prime, which is 3% over Fed funds. So as the Fed keeps raising rates, prime is going up. Our thought is, let's give your client stability. They know what the payment will be, and then they'll have an amortized payment that'll pay it down. And so a HELOC is a great product, but there's some advantages to doing a fixed rate second mortgages, and we have a way that we think that you guys are going to be able to make some money on it as well.
That's great. What would you say? I mean, there's a lot of loan officers that have gotten into the industry, over the last 5 years. And so entering and starting to build their career with the lowest rates in the history of mortgages, some of the highest production we've ever seen, and now the market's shifted a little bit. What would you say to a loan officer that's thinking about getting out of the industry because things have gotten a little tough?
Well, I think, it's interesting. There's a difference between a career and a job. And I think about that a lot when thinking about that question. And, I'll have people in our company and other companies ask me that. And so, do you view it as a career or a job? Anybody who gets into sales, people who get into sales generally they have a few similarities. And one is they are open to and embrace the fact that there is not as much certainty around month-to-month income. Because if you're like, certainty is something that's very important to me as a person, then those people should be in a salaried job. And that's okay. It's just that they really value certainty. If you're in sales, you're far less certain. That said, there's no cap on what it is that you can earn economically. And so you have a lot more flexibility. So that's one thing. And so right now, during 2020 and 21, the uncertainty, the other side of uncertainty is opportunity. That was the fun part. Right now, we're feeling the not so fun part of not having certainty. But if you view this job as a career, like I'm going to do it for 25 years, 30 years. I'm going to build relationships. I'm going to build my skill level, both in my ability to sell, both in my product knowledge. And I'm going to become really a fixture in my community understanding this. Then you're thinking about it differently. But if you think about it as a job, you're like, whoa, compensation's down, far more difficult, much more frustrating, not pleasant. And so there's no sugarcoating it. Life doesn't come with easy answers. And those who do extraordinarily well in this life, for the most part, it's not a surprise. They are willing to work harder and endure more and overcome obstacles that others are not willing to do. And so I say all that because this is the good times. What are you talking about? Have you seen my W-2? These are the good times because those who invest today, those who invest in themselves, those who invest in their product knowledge, in their skill, their selling skill, in their relationships, they will prosper 2 years from now, 4 years from now, 7 years from now, 10 years from now. It might be a very difficult stretch. I don't know. It might be 6 months. It might be 12 months. None of us know. But those who invest will prosper. Those who say, this is too hard. I think I'm going to go sell cars, or I'm going to go sell. Well, you know what? Then cars will be hard to sell at some point. Then what? Are you going to go sell cell phones and whatever the case may be? Now, if you're like, look, I don't like this, that's a whole different story versus I like it. It's just that it's hard. That's my advice, is that on the other side of difficulty is what is the prosperity that we all look for. And that sounds easy, but I think if you realize that, embrace how hard it is. I didn't write a loan today. Yeah, but I'm still here. I learned. I made 700 phone calls. That'd be a lot for a day. But the point is, focus on and be proud of what you can control. The number of calls you made, the number of contacts you made, the number of visits you made, the time you spent, improving your skill on product knowledge or on selling skill. And just say, I didn't write a loan today, but I got better. And tomorrow, I didn't write a loan today, but I got better. It's just like investing. Over time, that begins to accrue. So that's a long answer, but I really do. I think those people who actually embrace the difficulty and realize, like, this is the good time, because, this will be the last thing I say, every day there are people who are saying, forget it. Yep. And so you embracing it, you're going to have much less competition as the days go on.
Yeah. Yeah, look, if you were coming from outer space and your job was to figure out where you want to build a career, first of all, you'd look at the world and you'd say, I want to go to America. That's a prospering economy. It's solid long term. Then you'd look at the American economy and say, there's a lot you could do, cell phones, cars, but you'd look at the housing industry. So these human beings on this earth, they need a house. They all have a house. And I don't know when that'll change, probably never. And so I say all that because, what is a more long-term solid career to be in, industry to be in? American home financing. People are going to need houses and people are going to need money. And if you stare at a 6-month period or a 1-year W-2, and that's how you determine your mindset, then yeah, you're going to be all over the place. But if you look at it over a 10, a 20-year career in the mortgage industry, you're going to be wealthy, you're going to do well, and it's the most stable thing you could find.
It's funny, I'm a finance person, that's kind of how I came up, and so one of my heroes is Warren Buffett. Yeah. And Warren Buffett, when markets go down, especially when they go down a lot, most people are like, oh, this is terrible, sell, get out of, take my 401k to cash, whatever. Warren Buffett gets happier and happier and happier because he's like, stocks are on sale. Because he understands that it might be 2 years, it might be 5 years. He doesn't know, but at some point, those stocks are going to come back and those stocks are going to do well, and he's going to be thrilled to death that he didn't sell, and he's going to be thrilled to death that he bought. And so I think the same sort of thing. Those who, the not selling is not leaving something that you believe you're good at and that you're committed to. And so those who don't sell right now are going to be richly rewarded.
Yeah. It's an investor mindset versus a trader's mindset. So let's dive deeper. So we get the philosophy, but you both, 23 years, 25 years, you've been through many of these markets here at Rocket. And when you look at the history of our company, we typically come out of the other side of these tough markets stronger, more market share. Can you talk about some of those moments in your career in a market like this? What did we do? What did you do? How did we come out of the other side tactically? And what could the folks watching learn? Because they're thinking the same thing. Okay, I'm bought in. I know the mortgage industry is a great place to build a 20-year career, but what do I do today? So anything in the past we've done that they can learn from?
I'm going to kind of build off of what Bob said. So when I look back, I got in the business in 1993, so 29 years ago. My second year in the business was 2004, when the Federal Reserve started raising rates just like they are today. And I thought, holy crap, what did I get myself involved in? Then 1998 happened. Long-term capital management crashed, Russia defaulted on some debt, and 9/11 attacks happened. Hurricane Katrina happened. The housing crisis happened. The pandemic happened. Each one, as you plow through this, I think makes you stronger. You've built how to deal with these things. And I think what I've learned, at least, and again, it's where I sit. I'm in a role where I have to grow and protect the company, is that how we show up in these times matters to our people. Whether you're running a broker shop, a large lender, whatever, it doesn't matter. It's like stress reveals character. And I think it's important that in these tougher times that we all show up for our people, because this is when you get to think. This is when you really get to apply what you've learned over the years and try to help everybody else succeed.
Yeah.
I think of a couple things: liquidity, optionality, and investment. Liquidity, optionality, and investment. So if you look at, Dan Gilbert founded the company with his brother in 1985 as a broker. And he was a broker for 6-7 years. And so he and his brother started it when they were in their early 20s. I think Dan was 21. I think Gary, his brother, was 19. Gary was going to the University of Michigan while also starting the mortgage brokerage. Like, that's where they started, right? And so why did that turn into the largest lender in the United States? What happened? And there's a whole bunch of things there. But one of it is Bill just did a great job. Along the way, there were probably 10 to 12 times that were in the market that were scary and nasty. The financial crisis, you're watching, Fannie and Freddie, for example, went into conservatorship of all places. And there were many, many more things that were very difficult. But we always prized liquidity, optionality, and investment. Liquidity meaning you have enough cash that you're not being, liquidity is like, if you think about health, you can lose money for a while and it won't take you down. But if you have a liquidity event, liquidity is like a heart attack. It can take you down tomorrow. If you can't make payroll, you're done, right? If you can't fund your loans, you're done. And so always making sure you have enough liquidity to run your business is very, very important. So that's one, no matter what your size is, having a sufficient amount of liquidity is critical. Optionality, I touched on that earlier. You can't, in our business, any of us, no matter who it is, from the big money center banks down to the smallest one-person broker, if they can't sell their loan, if they can't get a takeout, they're done. Right? They're done. So we all need to continue to access that. And so who are your lenders? How many lenders do you have? How beholden are you to them? How much ability do you have to move from one to another? I think is really, really critical. I mentioned that earlier. Had we not had liquidity or optionality a number of those times that Bill just mentioned, we probably wouldn't be sitting here, right? And the last one is investment, and that is, especially when things are difficult, what are you investing in that makes you better the next time? Are you investing by adding a person? Are you investing by adding some technology that you need? Are you investing based on some training that you sorely are lacking? Constantly be investing, because you're either growing or you're dying. I really fundamentally believe that. And if you're like, look, I'm just getting smaller and I'm just going into a cocoon, that doesn't mean you can't be smart about some of those things, but you have to be investing in something, getting better at something. And if you're continually investing, and the best investment is in yourself, if you're continually investing, you have liquidity and you have optionality, you will not only get through difficult times, you will come out the other side in a much stronger position and continue to move forward. And after a while, actually, you start to look at some of these difficult times and say, I don't necessarily love it, but I know that I'm actually going to come out the other side stronger, and this is how I'm going to do better in this marketplace.
Yeah. It's interesting with maybe the opportunity not being quite what it was last year and the few years before, you have a little more time on your hands and you can be innovative. Sometimes when things are so busy, it chokes out innovation because you just have production coming in and so many people are in the money. Now is a time where you can try things. You can get creative. You can try a new piece of marketing or a new approach on a call or a new way to go get a real estate agent. And then, it might be the 10th thing you try and it clicks. Now all of a sudden, rates dip, refis open up, more inventory. That thing can help you scale. So sometimes a lack of opportunity spurs.
Dan Gilbert always says something along the lines of, when the world outside of you is moving faster than it's moving for you on the inside, the end is near.
Yeah.
And so it's a metaphor that says, the world is constantly moving. Your competitors are always out there growing and doing things. So are you innovating as fast and growing and getting better as fast or faster than they are? Because if not, then they're lapping you, right? And so I say that that's so important because at times like this, when things get tough, sometimes there's a natural sort of an inclination to go, I'm going to slow down. I'm going to go into the fetal position. And it's exactly the opposite. It is if I used to call on 5 people a day, now I'm going to call on 7. If I used to make this many calls a day, now I'm going to make that many calls a day. If I used to spend this much time training, now I'm going to spend this much more time training. And so this is the time when your internal clock speed, whether it's an individual or organization, needs to start going faster and faster and faster, because I promise you, your competitors aren't sleeping either.
Yeah, speed of the game. So liquidity, optionality, and investment in tough times. One of our partners, Mike out of Arizona, is asking about awareness. There's so much information going on. between the news, rates, the market. How do you keep up with the speed of the game? How do you stay aware? Are you reading things? Are you listening to things? You guys have to have a pulse on the market at all times.
Well, tell them your morning routine. I think you get up at like 2 in the morning or something. I don't know. But you have a routine. You've had it for 25 years, right?
Yeah. I mean, look, I've got some stuff I do for myself. I read every morning. Bloomberg, Wall Street Journal, Trade Rags, you name it. But I've got a great team. And quite honestly, they get a ton of feedback from you and our brokers as well. And I feel like if you keep the information stream open, we call it a feedback loop, you can pick up on stuff. And you got to decide what can you prioritize? What do you want to work on? What's meaningful? How do you want to spread the news? But I feel like it's just that speed. It is the speed of the game. It's like just being aware. And then to the extent that you and your team can decide, how do you want to act upon that? I think that's the key.
And I'm not saying I'm perfect at this, but I work hard at it. And you can tell I like analogies. You know that, Austin.
Oh, yeah.
Here comes one.
Some of them work.
Yeah, I have a 73% analogy success ratio right now. But
Fact check.
but if you just eat Twinkies, sounds delicious, by the way, it'll taste good for a while, but over time, you'll become less and less healthy, right? So I say that because it's not just the amount of stuff, of information you consume. It is the type of information you consume. And it is very easy to consume Twinkies. It is very easy to consume, like social media, innuendo, gossip, stinking thinking kind of stuff. That's very easy. It's like sexy, it's hyperbolic, it's like it attracts the eye. There's a reason social media is like the 10 biggest things that'll kill you tomorrow. Like, first of all, humans like lists, and secondly, we like, things are like, whoa, what are these 10 things? I got to read this. But it doesn't make you better. In fact, it makes you worse.
Yeah.
Because it puts you in a bad mindset. It makes you fear things that you can't control. And so reading things that you can control. And so what is it that's going to make you better? What will make you better? And if you're like, look, I want to know something about the market, there's a few things every day you can read about the market. If you want to get better at selling, there's a whole bunch of things you can go out there and read or watch that'll make you a little, and you don't have to become perfect in one day. If you spent 15 minutes every day for a whole year reading good things about selling skills, I promise you at the end of the year, you'd be a far more effective salesperson than you were at the beginning of the year. So think about what it is you're consuming and what are you hoping to gain as a result of that. And if you're really intentional about that, intentional about what you're reading and what the result you want, I think you'll have a ton of success versus if you just absorb whatever is coming in. Social media is fine. This isn't like me having a debate. Problem is the algorithm serves up to you what you're going to see. It's the opposite of intentional.
Yeah.
It is completely reactive. And so I think a world where you can be intentional about getting better and making yourself a better person to advance whatever it is. You want to be a better parent, you want to be a better salesperson, you want to be whatever it is, then really drive toward that. I think it's really, really key, even more so in the world we're in today.
It's so true. Like you eat Twinkies every day, your body's just going to want sugar and shit, and you'll just want more and more and more of it. And it's the same thing with negativity. Like human beings do, for whatever reason, want to eat up all the TMZ and the Desperate Housewives and all the stuff. But tactically, literally go through your social media, get rid of anything that's negative, add positivity. I think it's about consistency too. Like every morning I read the Morning Brew, right? Yeah. And it's just nice, clean package information on the market. I read it every single morning and just feeding yourself information. That's.
I'd also say this, you're spot on. A lot of people watching may own companies or may lead people. You can really assist helping them as to what information they're consuming by helping them, find a couple of things that are great and serving it up to them and saying, read this every morning. This could be really helpful to you, or really helping this with this message. I think that's a huge part of leadership, is to assist people with the information that they're getting and making sure that that information is helping them.
Yeah.
And so it's not just something you do for yourself, it's something you can certainly do for others.
Yeah. And the last thing on this point is, man, surround yourself with people that are also positive and that are getting better. And if you have folks in your organization that are no before yes, or of course try to coach them up and get them But if that's just who they are, get them out. Get them out of your organization. Get them out of your life, especially in times when things are tough. Surround yourself with folks that are positive, getting better. That's what your clients want to be surrounded by, your positive language, your real estate agents. Positivity is contagious, but so is negativity. You got to be careful. On a lighter note, from a partner in Ohio, Bob, what's your favorite Starbucks drink? What are you drinking right there?
So I've had one cup of coffee in my life. I was driving to Daytona Beach as a 17-year-old senior in high school for spring break. I somehow got the 2 a.m. shift. We were going through like Tennessee, I think, and we went off to some gas station and got coffee, and I'm sure it was really bad coffee. And I drank it, and I did not feel good, and so I've never drank another cup of coffee. So it is tea. That's what I drink.
London Fog.
London Fog's tea with some like milk stuff in it. I don't know. That's what I drink. Because I always feel like you look cool when you're carrying the Starbucks thing. I had Starbucks envy, and then I found out the tea, and I'm like, okay, there you go. It's better than a big giant Mountain Dew cup, which I've been known to do.
Yeah, I was going to say, this is his public drink, but then you go into his office, and he's just pounding Mountain Dew.
That's not true.
Consistently. Well, look, I appreciate both of you investing time. Partners, hopefully you got something out of this. As you know, we got a lot of things coming your way from, like Bill said, a product standpoint. We'll keep delivering you Pro Talks and bringing you relevant folks that'll help you grow your business and think the right way. But we appreciate you. Keep doing big things, and have a great week.